Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jade Aaron Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Shannon Robnett. With over 25 years of experience, Shannon has been involved from start to finish on over $350 million in construction projects and is dedicated to sharing his experience and expertise. And in just a minute, we're going to speak with Shannon about the multifamily marketplace. But first, a quick reminder, if you like our show, CRE PN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Shannon Robnett. Welcome back to CRE PN Radio.
Thanks, Darren. It's great to be here again.
Well, I'm so glad you're able to join us, and I'm looking forward to our conversation. For those that may not be familiar with you, if you could give us just a little bit about your background.
Yeah, so I grew up in a real estate family. My parents were always in construction and development. My mom was a third generation realtor. I'm a fourth. My son's a fifth generation. So I grew up watching development deals happen, and I got involved at an early age, and I soon figured out that working for, even in construction, even if you owned your own company, you could work for somebody else and you could make money. But the reality was, if you really wanted to get to where the real money was, you became the developer. You began to find the property, and then you built the asset. And, so I've done that whole thing for a long time, and we've just been we've been fortunate in the fact that, we currently have about $100 million worth of commercial real estate being built. And we've got about $200 million on our books to start in the next 18 months. We're just looking at how the market's shaping up and what we're going to do next. But it's kind of on repeat. Just really, we've seen it all before. It's coming back again. 6% interest rates are normal. We're seeing some very similar things that we've seen a lot in my past.
Yeah, no, I appreciate you kind of giving us the background there, and I look forward to digging into this a little bit. Just as a kind of a reminder, are you still kind of primarily operating in Idaho as far as your development?
No, we've got
investment?
projects going in Florida and Texas as well. And we've done some stuff in Washington. It's just it's been some value add stuff, but we're moving out from Idaho for sure. We still do quite a bit in Idaho. We've got a lot of people still moving in. I think we're the second or the third most attractive state by percentage of influx. If you look at numbers, we're not really there. When you've got, somewhere like Dallas, Texas, that, Colorado Springs imported 65,000 people last year. We don't have quite the size that we compete, but on a percentage basis, we definitely do.
Got it. And as far as the asset classes that you're active in, multifamily, and is it industrial, or what are the asset classes?
I grew up in industrial space. That's been kind of a bread and butter. It's funny. Multifamily is kind of everybody's darling. But industrial trades at probably 1% higher on the cap rate on a normal basis. Plus it's a triple net lease, which means that the tenant pays all property taxes, insurance, snow removal, lawn care, all of those additional expenses. And on top of that, they're usually 3 to 5 year leases, and a lot of them have national tenants and personal guarantees behind them. So it's really a better class of tenant. But when people think of industrial, they think of, those dirty old dingy warehouses down by the dock, right?
Yeah. Yeah. No, and I think that I've talked with numerous investors and people in the know just about the kind of the Amazon effect and all of the kind of flex space that's become so in demand and and everywhere.
Yeah.
So that's definitely an appeal there. Um, and you mentioned the projects you have in progress. Are those primarily multifamily, or is any of that industrial?
We've got, I just put another, $10 million industrial project under contract today. We're moving forward on, we probably have, of that 100 million, there's probably 20 million that's industrial right now, 25 million that's industrial right now, and the rest is multifamily.
Got
So,
it. Got it. Well, let's talk a little bit about kind of the market and the market cycle, and I'm trying to think of where the best place to start on this, because I think there's been kind of a sense of something was coming for as long as I've been doing this podcast, which I started in 2015, and at that point there was a notion of that we were, if we weren't in the eighth or ninth inning of the cycle, maybe this was going in extra innings, and then from then we went through kind of a minor slowdown, and then we had all of the boost of the additional printed money in the COVID situation, where a lot of extra capital was added to the market and interest rates were pushed down, and now we're at a point where interest rates are kind of the story, from as much as that, if I understand it, and you could certainly speak to it more, is just the market is trying to understand what's going on. The Fed keeps pushing the rates up, trying to get the brakes to slow down the economy a little bit. There's the concern of a looming coming recession, but then there's all sorts of signs that maybe it won't be a recession, kind of thing. And I'd love to get your kind of a sense on where we've been to where we are now, and then maybe we could pick up from there and compare that to historical cycles, as you mentioned earlier.
It's funny. I've seen government do a lot of really dumb stuff, and I think they continue to not disappoint. But when you have people, when you have the government really trying to control the money supply and do the things that they're doing with interest rates, the biggest issue that we have right now that is really hurting what they're trying to do is the fact that we have no inventory. I mean, we are, it doesn't matter who you talk to, there's not enough inventory out there, whether it's, we're 1 million housing units short. I've seen it up to 9 million housing units short. We still have a product constraint. And we saw that in my primary market during COVID, where we went down to a 3-day supply of real estate, right? This is the average. We've only bumped back up against 2.8 month supply, and that's now started to dwindle because people are starting to see that maybe the Fed's easing off a little bit. Maybe there's going to be a plateau here. But the reality is people do things based on what's happening right now. They tend to forget what happened when we had 8% interest rates. They tend to forget what happened when we had these other things, but really we're supply line constrained. And so as the market has shifted upward, we've definitely had pricing go up. So now a $200,000 house is $400,000. Well, $200,000 house at 8% is a very different thing than a $400,000 house at 8%. But what I've always seen in these cycles is the fact that everything happens in an order. First of all, you have pricing goes up. That's usually stimulated by some sort of funkiness with the interest rate, which we saw. And then you see as the bidding goes up, now we're seeing the pressure on wages. We've seen a lot of pressure that way. We're seeing job cuts, but I'm wondering if that's not a consolidation of, hey, we're cutting Jim's jobs so that we can pay Sam and Sally and Sarah what they're demanding because we've got to do this. So we're losing some jobs, but by and large, employees are being paid more. And that's kind of at the tail end of the cycle, because then what comes next is we now have $400,000 houses that are being bought by investors that are being financed at 8% that now need 2,700 instead of 2,700 a month, they're 3,700 a month. And that's what's coming. And so we always see these things happen in the cycles. And it's just at what point are we at? And then with that, we've got a lot of apartment investors, buyers that bought and thought, you know what, this is so great. We've got 2% money, but let's leave it flexible because we can get 1.78% money and we can save that extra quarter or eighth or whatever, and we can have this floating rate debt. So now we've got people out there that can't cash flow their properties. It's nothing wrong with the property. It has everything to do with the financing, right? And I probably see a deal a week coming across my desk that are, assumable loans that nobody wants, or they're, great products that are underwater currently, and really they would be underwater unless you brought a massive cash amount to the table to bring that equity cost down. So you're seeing a lot of this where people are absorbing the fall off here, where we bought it on the right thing at the right time, the wrong way. And so we've got a great apartment complex, the business plan executed properly, but the interest rate floated up and now it doesn't cash flow. So there's going to be some of that that's going to be a little bit painful. There's going to be some of that that's going to readjust. Unfortunately, with where pricing has gone, I think that most of that's going to be able to be absorbed by the investor, not necessarily affecting the bank, right? Because the product is stable. The product has received facelifts in some cases. They've received rent growth. They've seen them repositioned in the market well. And so there's really not a problem with the asset. There's a problem with either it's not even really the operator. In most cases, it has to do with the financing. So there's going to be some pain of that constriction and that absorption, but it's not, in my opinion, it's not going to be catastrophic, because there's lots of buyers out there that have the equity to come in and say, hey, you've got $70 million in bank debt on an asset that you paid $100 million for that's now worth 85. So we're willing to come in and buy that from you at 85. We've just got to get some adjustment here, because we're going to have to bring in our own $30 million to make this deal cash flow, and we'll be fine. And as the wages continue to come back into the market over the next 3 or 4 years, we're going to see that steady 3 to 5% rent growth like we've always seen. And now your $85 million asset 5 years from now is back up to $100 million.
Right. So if I'm hearing you right, it's just a matter of time for this to kind of reset, or if you have a long enough runway on your financing and you can wait, it will resolve itself. But it's more a matter of, do you need to get out now? Or is there somebody calling your note, or do you have to refinance or something like that? Is that?
Well, yeah, Darren, I mean, real estate is a long game, and there's a lot of people that joined in the last 18 to 24 months that thought it was a short game.
Casino.
They came into it and they said, hey, you know what, we can buy this, we can flip this. And in a lot of cases, they had some great success, but they didn't come into it with the thought process that maybe we need to have some prudent reserves. I mean, we went through the whole COVID thing, right? Nobody really got in trouble there because rates kept going up, property values kept going up, interest rates kind of substantiated that. But really where we're at, if you've got an asset that is not performing today because of the note, you're probably, if you can stabilize and stop that bleeding, you're probably somewhere in the neighborhood of 18 months from being right-sided back in that deal. It's just, can you survive long enough to be there? And in most cases, Everybody, I know of people, Darren, that got, they bought a $50 million asset for, sorry, $63 million asset. They financed 85% of the asset and 100% of the $5 million rehab on a floating rate debt. They got a little bit delayed on how things went together. They got a little bit delayed on their lease up. Their contractor cost them a little bit more. And they are now trying to lock in fixed debt today that they anticipated being 4% in their pro forma. They're toast, right? They're toast. So they're $1 million over on their remodel, 20%. Not terrible with everything we saw in COVID, but all things considered, they don't have enough runway and they don't have enough cash on hand to survive the deal. So now their $56 million strike price is likely coming in closer to 48 on a sale, 48 million on a sale that's financeable, which means that they're going to lose most of their equity, if not all of it, to stop the bleeding, because they don't have the ability to get further down the road to get this thing truly, honestly stabilized. Everybody says buy real estate and wait. But a lot of people that are getting hurt right now forgot that last word, and they just bought real estate thinking, well, this is a short game and we can flip and we can do this. And they're struggling. It's difficult.
No, I like your timeline there, about 18 months, because everything you point to is, I mean, demand is still strong. I mean, there's a need. Housing is, that riddle hasn't been solved just yet. As long as interest rates are creeping up and investors aren't, feeling 100% certain about what their costs are, it seems like, and you tell me, I mean, obviously we're just talking about people that have been caught. Are people getting, how are you structuring deals that you're offering on, that you're making offers on now, or that you're locking up? Is it still the same math that it was before, or is there a question mark as to what's the value, or is it just a matter of lock in what your financing is, know what your operation cost and your whatever development costs you may have, and then make the offer based on that?
Well, I've always made mathematically based offers. I've never been the guy that runs in non-refundable, $1 million earnest monies day one.
Money, yeah.
So and we've always made sense of it. If it doesn't make sense, you can't bet on yesterday, or sorry, you can't bet on tomorrow with the appreciation we had yesterday. Right. It doesn't work like that in most cases. And a lot of us learned that lesson in 2008. So we don't need to repeat that. Right. But here's what we've always looked at. If I can make it pencil today, I don't know of anything that has historically gotten cheaper and stayed cheaper. So if I can make it worth with today's rents, today's construction costs, today's rehab costs, today's interest rates, then the likelihood of me having a successful project are very good. So based on always doing that and always making the math at the front, it's never been about one of those things. And I heard a guy say this, well, you'll just have to bring more equity to the deal because your bank will only loan you 85% of the appraisal. Well, why are you spending more on it than the appraisal says it's worth just to get the deal? I mean, where is this really going? Right.
Right.
So people found themselves in trouble because they overpaid for it. They had expectations. I've seen stuff that even now shows 10 to 12% rent bumps for the next 3 years.
Right.
Well, who models that? If you're modeling that stuff, you're going to get in trouble, because there's going to be the year that you get a 7% rent bump or a 5% rent bump, or what we've always penciled in on our side is a 3% rent bump. And here's the thing, Darren, if I run my math the way I've always run my math the last 25 years, I look like a genius.
Right.
Instead of looking like the town idiot. Right. So the people that have not been doing that, they've been running it going, hey, I can pistol whip, or I can pencil whip this thing and I can make my numbers work so any deal looks good. We've walked away from a lot of deals. We've passed on a lot of deals, and we're having trouble right now educating sellers on what the deal's really worth with this interest rate, right? I mean, I'm paying, I'm working on a deal right now. We're about $900,000 apart. The seller doesn't think that's a big deal. It's about $4,000 a month at current interest rates. Well, $4,000 a month at current interest rates on a $10 million deal is the profit margin. I'm not going to go into the deal at cost, breaking even, hoping that somewhere between the time I take the deal down and the next 12 months, I'm going to somehow mysteriously run into appreciation that's going to give me profit. Right. But I'm actually having to have the conversation with the seller that shows him my math, and he's having to decide if he wants to sell today or not.
Yeah, I think that's kind of the feel I get from, just the things I've seen and people I've talked with. It's just, that the math doesn't work like it did, 6 or 9 months ago. And I would tend to believe, just kind of like we've been talking, that it's a matter of time. I mean, as the rents do continue to creep up, the NOI will improve. The cap rate, again, market specific, will again then determine the value, but it's not going to be a compressed cap rate that was 6 or 9 months ago, based on just unlimited demand and cheaper free money kind of thing.
Well, I can give you a quick example from my area. In September of 21, we had average rents in Boise were $1,640. They peaked in June of 22 at $2,085. Okay.
Wow.
Average rent in Boise. They've slid down now to about 1965. I was just looking at a model that was reevaluating a model that we're currently under construction on, that I had modeled 3 years ago. And I was adjusting my rents $575 to meet market today. Now that market has slid a little bit from the peak, but I'm looking like absolutely, even with cap rates expanding again, I'm still looking very good with my model, because I didn't think that the $1,640 jump to $2,085 in a 12-month period of time was normal.
Right.
All I did was applied some logic to it and went, we got to give up a little bit. And the funny thing is, Darren, when people look at Tesla or look at Microsoft or look at the price of gold, it's nothing for that to fluctuate 4 or 5% in a week and nobody freaks out. But if real estate fluctuates 1% in a year, even though your debt is fixed for 30, everybody loses their ever-loving mind.
Right. Yeah, no, it is kind of interesting. And I think that, there's kind of the fury of it all. I think because so many people, have found real estate as an alternative investment. Back in 08, when all you had to do was fog a mirror and you could, have multiple properties under, or own multiple properties regardless of your income. And there was just kind of a story, and there was a buzz, and it seemed very attainable, and everybody knew somebody that was in real estate. And, as an alternative, I mean, I think that, the stock market, the .com was kind of the similar story. Everybody was in the market. And it was, I can remember walking by a bookstore with my father-in-law, and he goes, the Dow's at, 10,000, he was thinking it should be like, 3,000, 3,500. That was his reference point,
Right.
And there's a big stretch. I mean, that's a, 300% or almost a 300% increase. And, so that I think that's kind of the news, and then you have this constant barrage of the information and stuff, to where it's really easy to get sucked in and pay attention to that. But I'm kind of curious, and would love to hear your thoughts on this. with the run up of the multifamily specifically since the 2008 crash, and the number of syndicators that have come to be or have entered the marketplace, where it used to be it was kind of more, and this probably more pre-Jobs Act is probably more one of the things that restricted the capital so much, but it used to be kind of more of a like an old boys network, or kind of a who you knew kind of thing, or you know larger um, funds or families or whatever that were primarily um, the operators or the investors in that space. But since the Jobs Act and around 2008, I mean, there's been a complete proliferation of syndicators, and obviously there's been plenty of opportunity demands stuff. My question to you is, do you think through this kind of the cycle, kind of going back to some historic levels, will that kind of thin the herd? Do you think there will be some that will um, get out, stop, let go, and it'll be more of like a more of a dedicated syndicators that are committed to the long term, or do you think this is just going to be the new norm and everybody in will continue to play?
No, I think it's like everything, it's the new, I mean, shoot, if you told people in 2011 you were in real estate, they treated you like you were a leper or, mentally deficient. I think it's kind of the same thing. We've gone full cycle. Real estate got sexy again. I mean, I ran into somebody I went to high school with, and they were a chiropractor in town, and they were now a developer. And so where's that going to go? There's got to be some of that clearing out, like with the .com bubble burst, with what's happened in the run up in the market, and hopefully the professionals will come in and clean up and take care of things, and hopefully the government doesn't decide to throw some more regulation on there to protect the poor unwitting people that got involved in stuff they maybe shouldn't have or should have known more about or whatever. But the reality is, I believe that with the lack of supply in the market, we have a whole different thing that's going to happen that's going to make it easier to clean up. When I was talking with Ken McElroy about where we're at in the ball game being, and now we've gone the other direction, right? When you were talking about the ball game earlier, it was the ball game from here to peak, right? Well, now we're talking about, we already know we've passed the peak, but where is it from peak to keys back at the bank because people are giving up on their projects? I think I agree with Kenny. We're probably in that second or third inning because of the lack of supply, because of the strong retail market that we have. There's still a lot of transactions going on. Go into a restaurant, they're packed. Retail stores are selling things. There's a lot that's happening there. Even though we're at a record low savings in America right now, we still have a lot of transactions happening. And I think that the rent market's going to stay strong. It's taken a lot of people out of the home buying mood and left them stuck as renters. But I think in all of that, you're still going to see that with high occupancies, rents increasing, it's going to be pretty easy for people to come in that have a good solid business plan, that have learned to syndicate properly, that have learned to raise capital, that can run these projects, be able to come in and assimilate that. So you're not going to have vacant buildings and half finished projects and those kinds of things. You're really going to be able to finish this out and walk it across the finish line without too much disruption. But there is going to be a lot of, let's call it short selling in the meantime, that people that maybe overpaid, maybe didn't quite execute the business plan properly, maybe have a little bit of an issue getting to the end of the day, that I think they'll be quickly absorbed though.
Yeah. Yeah, I mean that makes sense to me. Again, I think that it's kind of human nature to look to the last disaster for the answers for whatever the next one will be, or the crisis or whatever. And my sense of things is that whatever happened in the past, there have been efforts that have been made to correct or to not allow that to happen again. And so, even though you have some similar kind of uh, market conditions, the cause is not always the same. And, so how it will play out will likely be entirely different.
Yeah.
And, so I think
Well,
I think you're
and
right.
then you're right. I mean, then you're going to have, government come in and try and correct the situation and protect everybody and do the things that, well, maybe we shouldn't have. And, maybe you got to get a Series 65 to do this kind of thing. And maybe that's not bad. But then when you have those kinds of things, you've got the stifling of an economy for a little bit, an artificial constraint, if you will, on, capital coming into the market like we had in 10 and 11, where we really choked out home building because of all of the, regulation that was coming in because of the funky loans that were written in 08, 05, 06, those adjustable rate mortgages. So there's always that procession, that lag in effect. The effect happened. We had the low interest rates, prices went up, rents are now going up, and here comes the after effect.
Yeah. Interest rates, where do you think they'll kind of rest, or, what's your sense of things as far as where we are today and where we might be within 12 months?
I just got my crystal ball yesterday, but I dropped it and it's kind of cloudy right now. I'm hoping it clears up, but I think we are still going to see some rate increases. I think everybody's signaling that we're going to see another 0.25% this next time they meet. I think we're going to have another 0.25% after that. I think you're going to see toward the end of the year, we'll have eased our way up from 6 to probably 7. So I think we're still going to see some raising of interest rates, but I think you're going to see wages are going to have to push up to match that, to put people in a position where they can afford what has to happen. Because if that deal's got to get financed at 7%, the rent's got to be here, and people have got to be able to afford it. So it's going to come out of, then we're going to go back to the hurt cycle of, we're going to be pushing on employers to pay more because they've got to fund this up cycle. And then here we come with more inflation on pricing of what it costs for me to show up with my employees because of what I got to pay them. So I think you're going to see 7%, and you're going to see that cycle just continue to ease its way up through the end of the year.
Yeah, no, that's clearly plausible. And, I think historically, if you look at the markets, like we're, started the conversation, that historically, that's not been an outline interest rate. I can remember the first home loan I got was 7 3/8, and we were doing cartwheels because that was like, oh my God, where
There
where
used
the
to be that
market had
phrase,
been.
if it's under 8, don't hesitate, right? I mean,
Yeah,
it was so
yeah,
cliche, but it was. And yet now we've got the combination of the incredible price increase and the interest rate that make it a little bit different story. But at some point we've got to choke down and get through that.
right. You mentioned trying to re-educate sellers. What's the conversation like with some of your investors when you're raising capital?
Most people that we work with us based on reputation, based on knowledge, based on who we are and what we do. So it's really kind of we've had a shift from people looking at it going, all I want's appreciation, everything's going up, give me some more of that, to really maybe being a little bit more balanced in their portfolio and going, you know what, I really need to get some cash flow in my portfolio. I can afford to take some risk and some appreciation on these deals, but I like cash flow. We've always dealing with people who are looking for the tax savings. We do a lot of tax planning with our investors so that you can come in and we can say, hey, you need some of this, you need some of this, you need some of this. We can tailor that product and help you put together a plan. But a lot of people are shifting back to what I think should be normal, where you've got a balanced portfolio, you've got cash flow, so you can always take your appreciation deal. What you're looking for is, as the growth, and say, well, if that doesn't come through and it takes 3 or 4 years, I'm not trying to, I don't have all my eggs in one basket. And so I think we're seeing people kind of go back to what maybe is a little bit more normal and more maybe what I think it should be, where you've got a portion of your portfolio that's looking to grow and a portion that's tax free or in the tax realm of things, and then a portion that is cash flow based.
Yeah. No, definitely the cash flow is certainly a lot more or getting a lot more attention now than when it was just low cap rates and just turn it, kind of thing.
Yeah.
Get in, get out. Let me ask you this. COVID kind of introduced a sense of place that perhaps maybe I needed to be in a certain place before. Now I can be almost anywhere. I know certainly Idaho, Boise specifically benefited significantly from that. Just, people looking for a place that they'd rather live than where they were, knowing that they could work from anywhere. Do you see that continuing, or do you see the workplace kind of normalizing and being more on site as it historically were, or some sort of a hybrid of that?
Well, as you know, I've been my physical address is in Puerto Rico, and I live there and have lived there for the last 4 years while conducting most of my business in Idaho, and then expanding into other markets. But I think that the ability to work from a lot of places is going through its initial evolution. I mean, it's kind of like, we got turned loose and everybody went and did, and the whole work from home thing was all the rage and everybody was doing it. And now you see a lot of the major corporations kind of pulling it back. But, I was talking to a guy just today that, he's been working remotely for a company out of Palo Alto for 10 years. And so I think as technology allows us to do that, we're going to do that more. I know that Boise went from an average median income of $74,000 a year in Boise, Idaho, to $92,000 a year because of COVID and people that moved in with the higher paying jobs. So I think you're still going to see pressure that way. I think you're still going to see, people wanting to work outside of the office, but I think employers are going to pull back on that. So you're going to wind up with a little bit more of a hybrid. But the technology is there that wasn't there 5 years ago. We're conducting this Zoom thousands of miles away and not having any glitchy stuff like we used to have with Skype,
Right.
and any of that kind of stuff. So I think that that's going to make it a lot more practical. I think we're going to go through the evolution of, there was just this court case where a woman was caught not actually working, but she'd billed her employer for it. She actually has to pay the employer back. So I think there's going to be some more of that employee tracking stuff, so they recognize that you are working when you're working remotely. And I think we're just going to go through that evolution. But I know that work from home is here to stay, and we're actually incorporating that into some of our designs on our projects, because we know that people want those workspaces in the home again.
Yeah. No, that seems to make a lot of sense. Building that into the design there for place to
Darren, you
live.
remember when they used to build houses with a phone desk, right? I mean,
Oh yeah. No,
you had a desk and the phone sat over
uh,
here, and there was a
yeah,
drawer for this thing called a phone book, and
yeah,
a bucket of pencils and a tablet there to take note. I mean, we're just going back in time to go forward in time.
right. No, I was laughing as you're saying that. I remember the phone was attached to the wall
Yeah,
and a very short cord.
yeah.
You couldn't get away from the noise kind of thing. So that's funny. Hey Shannon, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And if we cannot avoid nor minimize the risk, we look to see if there's a way we can transfer the risk. And that's what an insurance policy is, a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be, their clients, investors, the feds, tenants, interest rates, however you would like to frame the question and identify what you consider to be the biggest risk. And for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Shannon Robnett, what is the biggest risk?
In my business, the biggest risk is taking on the project and having things like prices increase on commodities. We started a construction project, and our lumber costs estimate went from 3 million to 9 million. We locked in on the way up and caught it at about 5.5 million, but it was still a $2.5 million upswing on that. Those are the risks that we take as developers on brand new ground up. And so there's always that question that you have to ask, and it comes back to your underwriting. Do you have the runway to absorb this? Can you get from here to there so that you're not, your framing is in the first third of your job. If you've used all your contingency in the first third of the job, how are you going to finish the rest without additional cash? So are you properly capitalized? Have you underwritten correctly? Do you know that 3 years from now, when you're built out on a 200 unit apartment complex, that you're going to be able to sell? Those are the risks that we take that sometimes keep me up at night.
Yep. No, the budget and the actual definitely plan accordingly, I guess. Hey, Shannon, where can the listeners go if they'd like to learn more or connect with you?
The easiest place to find me is just shannonrobnett.com. You can go on there. You can connect with us there. You can get on my calendar. I'd love to have a call with you, chat with you about what you're doing, what we're doing. But we're there, or, all the socials. You can find me out there.
Got it. Well, Shannon, I can't say thanks enough for making time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
I appreciate it, Darren. Thanks again.
All right. And for our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.